All right. Good morning, everybody. We made it. It's what we've been waiting for all week. It's what the market has been waiting for. We've had nearly continuous jobs data coming in nonstop. It's just been different types. But today we're going to get non-farm payrolls, and it offers us an opportunity for a liquidity gap close play. So this isn't your typical gap, the gap that you think about in price, where we closed at one spot and we opened at another. This is a liquidity gap. You could consider it unfinished business if that helps with the visual. So at 8:30, we know like a lightning strike where we could get a lot of liquidity all at once. We get a lot of traders piling in, and if they all jump in the same direction all at once, then they're scrambling, right? So in this case, it's a down candle. If they can't find anybody willing to buy, then sellers have to reach lower to find someone willing to buy. Another way to think of it is sellers have to find it at a lower price, right? And everybody is trying to do that. Everybody's trying to sell and sell and sell and sell. Well, if you're selling something, you want as much money for it as you can get, right? So you don't want to sell it cheap. But if the person next to you is selling it cheaper than you are, you're not going to sell what you have to sell because everybody's just going to get it from the guy who's selling it cheaper than you. So everybody is scrambling to do one thing. In this example, it's down, but it doesn't have to be down. Some characteristics of what we're looking for today is we want no wick in the other direction. I'm going to show some up examples here in a moment. This is a down example. There was almost no wick going in the other direction, and we closed in the far side of the candle. We didn't pull back in the other direction and leave a long wick behind, and we didn't close somewhere near the middle. Now, maybe you don't trade futures or you don't trade in the Globex or you don't even want to trade this strategy. That's fine. I'm not saying you have to trade this strategy. You can just use this for your analysis and you can find trades that you like to take because of this analysis. We're very likely going to get a very big candle today. And even if it isn't a candle that looks like this with the no wick on one side and closing on the other, you'll be able to mark the midpoint of that candle, which will very likely become important. And you'll be able to mark the start of that candle because it's where we expect price to go again. At the very least, once we get into the open, you won't be trying to short this sucker thinking it's a really good day to go short. We got this gap closed around 11 o'clock. Now here's a different example going in the other direction, up instead of down. Almost no wick on the bottom. Started at 8:30. We closed in the upper portion of this candle. It did pull back some, and it highlights why we don't want to see any kind of pullback. It pulled back, and the next candle got stuck in that pullback. Now, there was still enough push. There were so many people scrambling to buy that we went ahead and made it up and we broke out through that first candle and we continued to go. But we don't want a lot of pullback. So this continued to drive, built a base across the highs, began its fade, and got the gap closed before 11. It was after 10:30, but it wasn't at 11. It was a little before. Here's another example. Almost no wick on the bottom. We closed near the high, tried to get a little bit more, and you could see the reversal really nice there. The midpoint was matched. So if we were to measure that candle and mark its mid, you can see how price reacted around the midpoint, the half back. We got the gap closed around 10:30 or so. Now this is what we don't want to see. Big wicks on each side. It closed near where it opened. This is not what we want. But if we measured that candle and we projected that measurement 50% higher, 50% lower, and we marked the midpoint, we could see price responded. It got stalled out at 50% of this range. After it stalled and it fell, it reacted at the halfback of this range. So even if you don't want to trade this, or even if it's a big nasty candle that doesn't fit our gap close play, we can still use that candle. Here's an example of using that candle. Didn't want to trade it as a halfback because it left a lot of wick across the top. It pulled back before it closed, and it had a pretty decent sized wick on the bottom. We don't want that wick, so we wouldn't want to trade it as a gap close. But I laid out my levels off of it, marked the halfback, projected the 1, 2, 3, 6 as I usually do. And even though I don't have the 1, 2, 3, 6 on the bottom down here in this picture, it responded to that too. It reacted at the half, reacted at the 1, 2, 3, 6. So just a good example that even if you don't want to trade it as the gap close, we can still use it for other things. Here's another 830 print, wicks on each side, don't really want that. And it reacted on the half, couldn't get through the 111 on either side. When it finally did later in the day, try to get through that 111, it still stalled out on the 1, 2, 3, 6, reacted to the halfback multiple times throughout the day. So at 8:30 today, this jobs data candle is very likely going to give us a really big candle. Even if it's not our gap close candle, it doesn't mean that we won't have some value out of it. Same thing with this one. If I had marked the candle out and projected it higher 50%, we could see the reaction across the high. It's likely that this was near or off of the halfback if we had measured the half on that candle. So you kind of get the idea, right? At 8:30, we're going to get data, and you can use that one single candle to lay out today's levels based on that candle. And, we still have open, high, low, close, yesterday's high, low, Globex high, low. We still have all those things, obviously. And then we've got cumulative delta, order flow, point of control, all the good stuff that we would normally use anyways. Markets are waiting on this data. A little bit of change, but Europe is basically flat. NASDAQ, Russell, everybody just pulled up waiting on this data. Japan's up about 0.5%, but really everything else is just on wait. While we do have other economic data today, the big thing is the unemployment data. So it's very likely going to set the tone, and then these others are going to exacerbate the situation. That's a big word early in the morning. It's just going to pour fuel on the fire. Or if it goes counter to the bias we already have, it likely just gets ignored, or maybe it slows us down a little bit. I doubt that it could turn the tide. So if the unemployment turns us, say, bearish, for an example, and later in the day they want to turn that around and make it bullish, I don't think they could do it with the rest of this data. But if, for an example, it turns us bearish and all of this other stuff is also bearish, it'll just add to the bearish bias. Same with bullish, right? Whatever bias we happen to get from the unemployment report, or from the jobs numbers, I should say. So when we attach the impact gauge to a lot of this, you can see that the bar is full on a lot of these. It's going to be like that throughout most of the day. Even Dally today at 3 o'clock, she can throw a fireball into all of this. So it shouldn't be a boring Friday, to say the least. So they're looking for 220 in November. They're looking for a recovery in hiring after all the weather related and the strike disruptions. And this is the last one before the FOMC decision. Eight 30, 10, and then we've got speakers at 9:15, 10:30, 12, and 1. So all day, right? But after 1 o'clock, if you're running 0-day trades, should be good to go after that. They are hedging this morning. They're so concerned about the unemployment numbers that we're going to get, or the employment numbers that we're going to get, that they're hedging. Now we're looking in the 40s here. I don't like it below 50 as a sign of liquidity in the overnight, but 40, 50, it doesn't matter what this number is. It's a little light this morning, and we can see the hedging. Now they're always hedging, right? I don't want to make it sound like they weren't hedged and now suddenly they're, oh my gosh, and they run in and take a hedge. Nah, they're always hedged. This is extra hedge. This is extra insurance. So, say you live on the beach and you've already got insurance, and then you hear the news and they say that there's this really big hurricane coming. And so you call up your insurance guy and you say, I think I want some extra insurance. You already got insurance. Yeah, but I want more for a month. Right? A little extra policy that doesn't last very long. It isn't my opinion that they're hedging, right? I'm not making guesses and assuming that they're hedging. We can see it right there. That label is the market maker move. That tells us that they're hedging, because how they hedge is they go into the futures, which trade 23 hours a day in the options market, and they trade these out of the money options. So we can see the thousands of contracts that they've traded this morning in the out of the money options on the calls and the puts. And that out of the money trading messes with the implied volatility average. So on the right side here, we can see that the front one is at 11.4 and the next series out is at 8.2. When the front series is higher than the next series out, you get a market maker move. And that's how we know that they're hedging. Generally speaking, this tool is used for earnings and biopharmas that have new drug trials and that sort of stuff. But it can be used on anything that's got options where we see them hedging in the front end, because that's what it's designed to highlight. So after non-farm payrolls, we want to see this number start to go down. Either way, its life is limited. It will be gone by the end of the day because it's using the front series expiration. By the end of the day today, it will not be here. So it's going to get smaller and smaller at some point today. But if it's on here strictly because of non-farm payrolls after 8:30, that number should start to decline and it should disappear off of the market maker move system by, say, 9:30 or so. If it's still there after the open, then non-farm payrolls isn't what they were scared of. If they didn't take the hedge off and it's still there or it's gotten bigger after non-farm payrolls, then that's not what they're hedging against, which would make you want to go back and look at all of the events that we already looked at and ask, all right, well, which one are they worried about then if it isn't non-farm payrolls? I'm pretty confident in saying that it's non-farm payrolls, but I get it wrong too, guys. So if it isn't non-farm payrolls, we'll know, because this number won't go down. It won't start to disappear, and it'll linger into the next event. So you do want to keep track of the overnight volume. It's a nice tell on the sort of activity we had in the overnight hours. It kind of gives you a heads up, right? I don't know about you, but I don't keep track of other nations' holidays and when they're open, when they're closed. So when I come in and I see the volume is light, I can start asking questions like, why is the volume light? Was the nation not opened yesterday, right? Where they closed for a holiday or something? And then I can go check and see. That way I'm not checking every day. Hey, were you open? Were you open today? What about now? Were you open now? Because that would get monotonous and boring and frustrating. But if it's light, then we have a reason to go look and see, were they open last night, or is there some other reason that the volume is really light? Kind of also gives us a heads up, because if everything was open and the volume was light, then they must have been sitting out. What are they sitting out for? Then you can go after the news and try to find out, what are they scared of? Because if they're scared of it, you should probably be scared of it. There also is the idea that we had a very narrow IB last night. The IB is the initial range. It's a very tight collection of price action here, kind of indicating to us that they're sitting out waiting on something. If it looks familiar, it's because we were doing it yesterday too. We've been doing it a lot this week. Sitting out, sitting aside, waiting on data because, well, these are really big events that are likely to shape the future for weeks to come. And so they have a large impact perspective. We are resting on the 3-period daily moving average at the moment. So if you were to go to a daily chart and put on a 3-period moving average, you would notice that we're sitting on it. We've been crisscrossing it all night long, kind of hovering around it. This is what it would look like on a daily chart with a 3-period moving average. Who cares, right? We don't use moving averages for entries and exits and reasons to trade, but it does provide insight. There's a moving average combo called surge, where you take 2 moving averages. I like the 3 and the 7, 3, the 8, 8, 10, 3, 10. You use a small moving average combo and you look for the surge signal, which happens to be price crossing through both of those moving averages. Ah, my cat crowding me up and pushing buttons. Back up, bro. There we go. The moving averages then cross each other, and you've got the 3 on top of whatever you used. I got the 10. So price crosses, the 3 crosses the 10, and then you've got your search, and you get a nice move like that. That's what we're looking for. Well, it can happen in the other direction too, right? So flip that over the other way. If price crosses the 3, cuts through the 10, and then the 3 cuts through the 10, you've got a search to the downside. Right now, we've got a textbook picture fork example, right? All of the moving averages, like the tines on the fork, equidistant from each other, spread out nicely and all pointed in the right direction. Price would have to cut under the 3 and turn that 3 to the downside to get it to roll over, like it rolled over back here in the same example, where price first gets under the moving average and then the moving average 1 gets under moving average 2, and you get your surge signal to the downside. That's a multi-day outlook, right? Which first starts with price getting underneath the 3. And I'm not talking about just, you know, one candle down and then coming back up again, crisscrossing back around it. If you've heard me talk about the point of control before and how we can hover around that area once we get into the point of control, it's kind of the same situation here. That we've got price when it gets to a spot like the point of control or the moving average, where it'll begin to act a bit like a magnet and turn into a zone, and we just cross back and forth here. If we leave this range and then we come back to it, it's likely to act as a support if we went higher. If we leave the range to the downside and then we come back to it, it's likely to act as a resistance. But as long as we're around it, it's very likely going to act like it is right now, a magnet. So you can go back and see examples of this where we've got to that 3 and we just kept pulling away from it, retesting it, pulling away. But when we finally got through it, even coming back like a Busby on the other side and testing it in the other direction. So we have to get through it. And then we have to get away from the zone that we've built and then come back and check against it. It's a lot. It's not a one-day thing, right? You just want to keep that on your radar that the 3 is there and that it's looking like we could see a 310 cross. We have large periods of time where we get above that 3 and we maintain it for weeks and weeks. And then we finally roll over it and we cut down and we get a nice little reset before a continuation. So when we do roll under it, it can take days to weeks before we cross back above it again. It's been a wild week in the profile space. We no longer have a classic shape at this point. Point of control down at 60.59. We've got another D shape up around 60.95. The value area high line, 60.92 cog line. And then at our current location, we're building out yet another D shape. Well, we got your classic singular D and then a 2D, but once we start getting 3, 4, and 5 Ds, then it's just a mess, right? Like back here where we had multiple high volume nodes, it's just a mess, right? So we do have a bit of a shallow area underneath 6,000 that we could fade back into that 50.92, but that's a long ways off from 60.84. Another idea being that if we break our own low at this 60.78, we're likely to drop back down to the point of control. Now, that logic makes sense, but we were saying the same sort of thing yesterday when we were at 60.95 and we didn't have such a high volume node here. And the idea was, well, if we break this low, we'll likely fall down here. And we didn't. We broke that low and we dropped down into the 80s and then we stopped and we've been basically basing on that 3-period moving average. I don't think we have a voodoo line there, but it won't hurt to check really quick. Yeah, we got that's buy. Now we don't have anything until 59.50. So we've got the CPR. It doesn't hurt to look. Just keep in mind that the floor pivots and central pivot ranges will take a back seat to the sort of flow that we're going to get from non-farm payrolls, right? A pivot will be run over when an announcement comes out. So other than that, today's floor pivot is higher than yesterday's. That's bullish, but price opened underneath it, and that's bearish. The two channels are overlapping each other. That's considered a more neutral bias than anything else. So, put those all together and we don't get a lot of edge from it on this side. So far today, we have a MDP. That's a missed daily pivot. We haven't hit today's pivot. Just like yesterday when we were talking about a missed daily pivot early in the morning and we had not hit it yet, we hit these pivots about 80% of the time. So like yesterday, when we're thinking about, could we come down and hit that pivot? Well, we had an 80% chance of doing it. Sure enough, we made it down and we hit it before the end of the day. So far today, we haven't hit this pivot. Now, 80% doesn't mean we're going to hit it. Here's an example of an MDP. We did not hit this pivot, right? So 80% is not 100%. I think the only 100% in the market is that there's a 100% chance you'll lose your money if you trade long enough, right? You're going to lose sooner or later. You're going to lose. I think that's the only 100% guarantee that I know. So don't try for 100. This market maker move has one additional aspect to it, and it comes in with the ADR levels. So this is today's ADR. Because we've been waiting on data all week, it has shrunk from 1.06 down to 0.86. So it's getting smaller, and that makes sense because it's based on the average daily range. And if our range has been really small, then so is the average range that we're likely to move. But we take this market maker move and we apply it to the outside edges. So we would look at, call it 25 points, and we would look at our highest and lowest point, take another 25 off to the downside, and add another 25 to the upside, and those would be your outside lines. Because we could move an additional 25 points on top of our regular ADR today. We can just do the math with these two numbers. The ADR is 50 points. The market maker move is 75 points. Our high low today is 70 points higher or 75 points lower from the close of last night. That's a pretty good number. It would certainly put us into all-time highs if we made that move to the upside. 61.50 by the end of the day would not be out of line. 10-day, 30-minute volume profile, and what do you know? It came up to us. So we had the point of control with us in that chop last night through the Globex before we got into the RTH. Now we're underneath that, holding in this new zone, and we can see TPO is already building up at this level. If we stay here for the rest of the day, it's very likely that we'll bring that point of control down to us by Monday. But I find it really hard to think that we're going to stay where we're at in this really tight range for the end of the day. So we're very likely going to move out of this zone, either drop back down into these previous levels and or expand this range to the upside. Just keep in mind when we get new candles on the right, we're going to take candles away on the left. So if we just scoot this forward a little bit by Monday afternoon, maybe Tuesday, if we didn't make a new high, and I find it unlikely that we're going to hit 59.70 today, that the profile will likely have shrunk at least this much. And we'll be worried about where the point of control is going to go. It's likely going to end up in this 60-60 range if we fade to the downside more. We'll get stuck in that area. And since we won't be losing any candles back here for at least another week in this area, that would be our new point of control. Of course, we could overshoot that, get into that air pocket of risk, and then end up in the 60-32 cog line. But that's a bit more extreme than I'm expecting today. Everybody seems really worried about the numbers, and if they're bad, I think we could get a little ugly out there, but they want the cut, right? So it's like, is bad news bad or is bad news good? And if we do get good news, is good news good or is good news bad? What do they want more, right? Do they want that cut? Or do they want to know that everything's on track and doing good? We do got a new VPOC from yesterday. And since this one got hit, we'll just take that line and move it up. So 60.95 is a VPOC line. We've got this cog line down here. It's not a VPOC anymore since it did get hit, but I'm going to adjust that concept and say, yeah, you know, we tagged it, but there's probably still a lot of liquidity there. So I'm going to keep it on the screen. I just changed its line type and color so we don't confuse it with the other line. This 60.95 is really close to the 60.92 cog line. So certainly want to keep your eye on that one. If we do make a break back to the upside, we're probably going to struggle with that. Get a first touch play at least. Otherwise, a break to the downside, once we get through 60.63, we've got 60.15 down here. And of course, to get there, you got 60.32 cog line. We're still a 0.5% above the 10-day moving average, but we are fading back down to it at the same time that it's running up to us. So as long as we just hold the line, it's going to come to us. We'll get our reset or our correction, and we'll be good to go. Since it's Friday, we've got next week's levels showing up. Just keep in mind that next week's levels are not set in stone yet. So when we look back, we've got all these weeks, and these lines won't move. They're set. They're not going to change. But they don't lock into place until Friday after the close. So while we can see next week's range now, the midline is our current price. And as the ES ticks up and down, the gray line is going to tick up and down. The red and green line are going to adjust around it. The distance of this range is based on time and volatility. I'd like to tell you that the information came from right here. That's next week's expected move right there. Next Friday's expected move, our week's range. So you could just take that number Friday at the close, you'd be good. That's what it's trying to give you, by the way. It's just that it can't give it to you. Thinkorswim doesn't give us the opportunity to put that kind of code into an indicator. I know because I code Thinkorswim. So this range has to be derived by other means. I didn't build the indicator, by the way. Mobius did, but he used some fancy math to figure out the range to try to mimic what you can get from here. So if you want to just draw the levels by hand, your lines would be more accurate than that indicator. Having said that, you know, if you're only trading one name, that's no problem. You could just mark it on the ES and call it good. But if you're an equity trader and it's Wednesday afternoon and you come across something that you decide you want to trade today and you didn't mark last week's levels on Friday, well, now you're SOL. You didn't mark them. So it's good enough, right? It gets the job done. But if you're going to trade the same thing over and over and you're not looking at a bunch of different markets, drawing them by hand would be more accurate. Still, it is a preview of next week's range. What we want to do is compare it with this week's range and ask, what does it look like? So we'll just make the box this week's range. We'll lay it on next week, and we can see that next week is projected to have less volatility than this week's, less movement. Since volatility is a nerd word for movement, this range is derived by time and volatility. So if the range is smaller, we got to ask, is next week a 5-day trading week? Yep. Okay, so they got the same amount of time. It has to be that next week has less volatility. Now that's a little bit worrying because we've been worried about non-farm payroll for 2 weeks and we've been sideways for half of this week waiting on non-farm payrolls. What's so big for next week that they're so concerned that they're going to wait and that it's expected to be even less volatility than this week? Or on the other hand, is it really just lower volume, lower volatility? FOMC is on the 18th, so that's not next week. It's not OPEX. So that's not now. OPEX isn't next week. We've got CPI on the 11th. That would be the next biggest thing. If it's enough to concern investors, we'll find out on the 11th. So we're just going to leave that there. We will revisit it on Monday and see what the actual range is. Right now, it's just a projection. It's not set in stone. 0.5% above the 10-day is a good place to be. The fade back implies we could get a little reset, right? Get a little bounce off of it or get near it before the next rally. And looking at the 10-week, we're still 2.76%. Just compare that over, this range here. And you can see how we kind of topped off and we're just gently fading down a little bit. And that's fine. That's exactly where we want to be. We're not overextended or overbought, at a like 4.5 or 5. And we're not back to 0 or near the 10, which would act like gravity and kind of pull us into it. So we're good. It's a good place to be. We're not seeing signals of any sort of mean reversion or least squared methods or anything like that that says we have to pull back and come back down. So things that are down today, Bitcoin, nat gas. I mean, really, that's it. Our benchmark is 0.5%. So all of these others, they're not even down 0.5%. They don't meet our qualifications. Looking at things that are up, China ADRs, Baba, Baidu, JD, PDD, XPEV, Neo, all those guys as up 1.25 plus. Consumer discretionary is up, which is nice because if we want to have the Mag 7 and such get rowdy, then kind of want consumer discretionary. We could see the Mag 7 group is moving up in the right direction, but they're not up enough yet. They're still underneath that 0.5% benchmark. Over a 5-day period, the Mag 7 group is up more than 4.5%, so they're moving in the right direction. And we've got retail, solar, both of those tie in well with China being up. And to the downside, crude with Bitcoin and nat gas, precious metals like silver, some pot stocks, but not enough yet. We need more negativity out of the pot stocks. Semiconductors are leaning to the downside. They're not down enough yet to meet our qualifications. We want to see that turn around. So after we get this 830 print and we're getting closer to the open, if we're going to get one of those rally days, you want to see the Mag 7 maintain its bullish bias, bring up the semiconductors, get consumer discretionary in there, and really take that home and get that move to the upside. If it starts to get negative, we want to see semiconductors leading the charge to the downside, bring in consumer discretionary behind that, maybe even get the banks involved, something like KRE or more generically XLF, and just hammer it down. The reason I bring up either one of those scenarios is it's likely we get the third scenario. And I don't want the third scenario. That would just be a waste of a Good Friday. But the third scenario is that we just go sideways quietly into the close. that sideways range could be as high as the high that we set yesterday and the low that we set on the 3rd. That would be really boring to just wrap it up and maybe even a little tighter than that. Wednesday's low and Thursday's high. We could just stay there and chop for the rest of the day. That would be your Friday. I don't know about you, but I don't want that. So if you want a breakout or a breakdown, that is the plus and minus that you have to get through at this point. You want to break down, get down below Wednesday's low. And if you want to break out, get out above yesterday's high. Because at this point, if you're going to run the 111 with the yesterday 111 that I like to play, that's the 111 you need on either edge. Of course, that one trade will make a house payment, so all good. So what I got for you guys, be careful, be safe, keep your eye on the clock. Remember, we got Fed speakers today. They can chip their teeth, be taken out of context, misquoted, and can spin the market into a cycle that they weren't intending to do. So don't sleep on them while they're speaking. Have a good weekend. I'll see y'all next week.